Okay, so today I'm going to go over just a couple of bullet points. I'm going to explain to you how to trade, what you must know before you start trading. I'm going to explain to you a very important practice. I'm going to explain to you as well when to close a trade, when to wait and not trade. I'm going to give you an idea of the capital required to trade. I'm obviously going to remind you, like I always do, to always follow rules. And I'm going to explain to you a little bit more about pyramiding, basically the law of compounding, and how you can use it towards your advantage, depending on your account size. So I'm going to give you this kind of insight today. Before I begin, I'd like to ask you all, do you have any questions? It's okay, Johnny. So basically from now on, everybody will be receiving, you will all be receiving emails. And every time you see this chart that I sent, again, when you see charts, that means that there is a trade there. We will not show you a chart for no reason. So you're going to see, you're always going to receive a trade. And they're not all going to be correct, but they're going to be, pretty close to 7, maybe 8 out of 10. In some weeks, we're going to be correct every single day. The longest streak of winning trades that we gave out is 27. So we had 27 days in a row of winning trades. And our trades are not winning. We don't target small amounts. We target something bigger. Very good, Johnny. Johnny says that he's going to take 8 out of 10 any day. Nelson, you will be added as well. Thank you for sending your email in there. Okay, Jeff says he opened the chart on Sunday night. Basically, the developers of CTrader, they're called Spotware. They update the platform every weekend. Unfortunately, this time when they did an update, they made the mistake. Well, obviously, I'm not sure exactly what happened, but obviously there is a mistake involved. But that's progress for you, and just like trading, you need to lose some to make some. So far, CTrader is a very, very good platform. Unfortunately, the web browser stopped working today, and I wasn't even able to get on it, and nobody else pretty much who uses CTrader, every single broker. So sometimes these things happen, but it's the first time we had it, and we use CTrader for many years. No, you're doing everything right, Jeff. You're doing right everything. Oh, Craig says it worked for him fine today. When did you log on, Craig? How long ago? I'm just going to try and do this very quickly. Nope. Still not. All day, huh? Okay. Well, you're one of the lucky ones. Lisa actually has probably one of the best questions I've seen in a very long time. And she says, Dennis, I want to start to write a trading plan. Okay, it works now. Okay. So CTrade, no, it doesn't, or does it? No, it doesn't. So this is what many people got. They got this just spinning around. So it's not everyone, but majority of people did. Perhaps if we create new accounts, maybe it's going to work. So I'm going to try this until tomorrow and tonight after we finish this workshop. But let me just repeat Lisa's questions. She says, Dennis, I want to start to write a trading plan. Is there a list of important bullet points I can start with? Lisa, this is what we specialize in. Last year, if anyone of you have seen our website last year, you would have noticed the first page was reach your financial goals in 2015, start with a trading plan. Basically, there was a very nice ship and an ocean. So we believe that we take Benjamin Franklin's advice into this very much. What I mean by this is we follow the quote that states, if you fail to prepare, you prepare to fail. So in reality, what I'm doing with these trades is trying to prepare you for something. But I'm going to be explaining if you don't follow these rules pretty soon. Many traders, and there is a reason why they say that 90, even 95% of new traders that pop into the market lose all their money and they stop trading. Who received today that email about 5 steps of a trader? Well, I'm very glad, Lisa, that the web trader worked for you. Many people have had an issue. Okay, great. So a few people received it. Well, Lisa actually didn't read it yet. Basically, it's a small explanation of stages of traders. You can even take it into what's it called? Let's say like life. You know, when you're a teenager, you're arrogant, you're direct, you want to do things your way, you don't listen to other people, and as you mature, you start becoming wiser. Well, hopefully, we become wiser. So it's basically that. And at the last stage, and this article I've actually it's not written by any of us here. It's an article from a very smart individual. So this dictates the couple of steps of trading, and if you realize one of them is having a clean chart, eventually your chart is very clean. This way you can understand the market better. I understand as well that sometimes it just gets too hard, you know, just like, let's say, a habit, you know, because at the end of the day, we are creatures of habit and we create good and bad habits for us. Problem is, it's very hard to break bad habits. It's easy to break good ones, but it's very hard to break bad ones. So that's why we get attached to stochastics and MACDs and ABCs and so forth. So all of these things get attached to these things. We as individuals get attached towards these things, and then we don't achieve much. When you have a clean chart, you can see what is happening in the market better. Now, what I'm going to explain to you about these yellow lines over here, they're added like this, vertical lines. What these lines are is basically they are a separation of weeks. Exactly 30 weeks from one from the other. As you see, period, it says 30. We're in a weekly chart, one period is 1 week. I want you to understand how markets fluctuate in weekly times. Next, on Wednesday, I'm going to explain to you how this all works on monthly and then eventually yearly. It is very important to understand what kind of a market we're in. On the short term, many people thought, and I showed you this last time, that this here is price getting ready for a bigger move. And it is. It definitely is. But when you zoom out on a weekly chart, you understand that we're not there yet. So there is a very big move preparing for this. And this could be the final time it reaches the top part or even goes back to the bottom part. Now, we are at two very uncertain levels right now in the financial markets. We are very close to a recession, and as the article today stated, recessions, minor and major, happen between 2 and 3 years. Right now, we're at 3 years since the last one. And we're not there yet, but we are pretty soon. And don't be worried about something. Like I said, they happen every 2 to 3 years. We're all still here. We're all fine. We're all healthy. We're all happy. If you have internet, that means at least we've got some money, to pay our bills. So we're fine. There will be a major recession. Well, I can't promise you this or tell you guaranteedly that it will happen, but there will be something happening. For example, you see this here. You get the bottoms and you realize the market works in cycles. Sometimes those cycles are broken and sometimes they're not. So if we connect all of these levels here, we have 3 very interesting points of interest. Okay, and we can do this for many other levels as well, but I'm not going to get into this right now. What I'm trying to show you here is cycles. Markets move in cycles, and the best way to predict them is on monthly and yearly charts. You would have to use something else though, because CTrader doesn't load, and even MetaTrader and most trading platforms don't load too far out. As you see, 1991. Okay, this is because the euro didn't exist prior to that, but it's important to understand the longer scale of the dollar, for example. So this is what I want to show you. Markets move up this week, in this 30 weeks, and then rapidly down towards the end. We moved into this level, we went down. Okay, we created a double bottom here. It's very important, and I'm going to get into these things when I start talking in about 7 minutes, about double tops and double bottoms, what you want to find. This is a descending double bottom, indicating price moving downwards. This here is another double bottom. These are very interesting points and can make you a lot of money if you're patient. So before I begin, let me just see if there's any questions. Yes, it is a really good article. It can help a lot to clarify yourself and to understand where you are. But don't lie to yourself. Don't think that you're at the last stage or the fourth or even at the first. Don't push yourself forward and don't push yourself backwards. Be realistic about it. My good friend Attila, yes, I will add you to the mail and you're gonna have it. You're gonna start receiving these emails daily from us. So before I begin, does anybody have any other questions? Jeff says that he still fights overtrading big time. Yeah, it's well, you need to basically slap yourself out of it. I would recommend, just a quick question, do you have a trading station? Is there a specific place, maybe an office desk that you sit at when you trade, or do you just sit wherever with your laptop? So you have a trading station. Well, look, I just have one picture here on a little yellow note, and it says, always follow my trading rules. And if I could connect my telephone to this and send a picture, well, I use two PCs as well. I use a desktop and a laptop. Actually, I use two laptops and a desktop. But that's because I need to run a business somehow. So, okay, basically I have just one sticky note right here. Before I used to have many, but all of those very important sticky notes that I used in my old house guided me towards something correct, but they distracted me as well. So I just have one right now. And all it says is always follow my trading rules. That's it. Because these rules are the backbone of trading. I know that if I break one of them, I'm going to lose money. But if I follow them, I can save a lot of money for myself and for anybody else. So I'm going to just begin here on how to trade. Once you're basically done with all of this and you inherit the trading rules, obviously apply the risk management to all of your trades, every single one, whether it's tiny or very large, have a cleaner and more simple chart. Only and only then you should begin investing. So once again, when you inherit and really put the trading rules onto you as much as your name is a part of you, apply risk management to every single trade. Have a clean and very simple chart. Only then you should really become, well, that's when you're an investor. So that's when you should start investing. So the Forex market is actually very, very amazing. If a trader is serious, dedicated, and obviously learns to use the most important muscle we have in our body, the brain, then that person can, in the financial markets, turn very easily. And I say very easily, and that's if everything is followed, but we're creatures of habit, so we don't follow many things. But you can turn a $10,000 investment into $1 million within 5 years or 15 months. Obviously, this depends on your goals and your trading style. These are big statements I'm making here, but I'm going to explain. So such fantastic results are very possible in the financial markets, and people have done them over and over again. Now, the techniques that are present here that I'm talking about can be very easily used to generate a 25% return over a monthly basis. If you do this on a consecutive level, this will give you, the investor, a decent 300% return at the end of the year. But even if you compound 10% over 12 months, that is 120% at the end of the year. And this is easy to be done. For example, this account here, which is basically just a small trading account, it's nothing serious, made 2% in a very small period of time. If the gold trades didn't hit out, this one's here, this account would have made good money. It would have made good money. So what I'm trying to tell you here is if you compound your profits, keep your risks at a minimal level, and compound everything properly, have proper risks. If you say you want to turn your investment by yourself into 120% a year, all you have to do is make 10% a month. If you make 10%, you relax and start analyzing, start understanding where the market is going. Next month comes, take proper trades, careful trades, follow rules. Another 10% comes. If by chance you achieve 12% in one month, next month all you have to do is get 8. You cannot put greed into the markets, because if you let your emotions take over, you are kaput. You're done. A serious and profitable trader only looks for long-term commitment to the market. he or she is here to stay, you know. So what they do and what they know is what their initial investment is, and they know where they want it to be in 12 months, 25 months, and 50 months. So when you make an investment, whether it's $100 or $50 or $5,000 or $100,000, doesn't matter. Percentage gain is all that counts. When you talk about rewards and returns, don't say I made $20,000 or $200. Talk about percentages, because percentages is what matters. If you're risking 10% to make 2%, you're eventually going to get destroyed. If you're risking 2% to make 10%, that buys you a lot of time, because then you can lose more trades and learn much more. So I believe we have just a quick question here. Yeah, Jeff says you're trading against the computer. You have to think like computers. No emotion, no discipline. No excitement to win, no depression to lose. You are one. You couldn't be wrong. You couldn't be more correct, you know? Very well said, Jeff. So like I said, a serious trader looks for long-term commitments to the market, and a serious trader is basically here to stay. And I'm sure you all know that you can make very good money in this industry. So it doesn't matter. You don't have to rush into it. You don't have to open trades every day. You know, if, for example, let's say you want to turn 10,000 into a million in 15 months. Listen to this. 10,000 in 15 months. All you have to do is make a minimum of 8.9% per trade every 9.7 days. And the 10K would become 1 million in 15 months. I know this sounds very simple, right? Because we're using math to do it. But it requires much more than desire and goals. It requires time, it requires rules, it requires... Well, it doesn't require emotion, and it doesn't require greed, most definitely. So you can do it. So if you have a goal, you need to break it down mathematically. If you don't know how to do it mathematically, use a calculator. It's very simple. And then you would understand how to do this. But Lisa was asking about trading plans. Your trading plan would need to have this. Because trading indefinitely without goals is like taking a bow and arrow and shooting into the sky and hoping you're going to hit something. The only thing you're going to hit is maybe a pigeon. But most likely you won't hit anything. So to have goals, you need a bullseye, right? And if you're an archer, obviously the bow and arrow. So to get that bullseye, you need to practice. Only if you trade based on luck will you hit that bullseye by trying repeatedly. Trying repeatedly will burn you out. Constantly changing a trading system will burn you out. Constantly changing ideas will also take all of your money. So you need something consistent, but you need something simple. You need a chart. If you want to really make money in this industry, you need a chart that you can look at and in a matter of minutes understand what you want to do if X, Y, Z happens. Best scenario I can tell you is you're looking at the long term here. We're talking about very strong levels, because on a 1 hour chart, or even worse, 15 minutes or 5 minutes, you're not going to find this. Okay, you're going to see nonsense, and you're going to go for nonsense, and probably 4 out of 10 times you're going to hit something. But the problem is, because you're trading on such a small time frame, you're aiming for little pips, because in reality it looks like something, but it's not, and you're taking big losses. And I spoke about this before. Small profits, big losses. Many of us, including myself, is guilty about this, for this. So we see a very strong, we see a very, very powerful here level, and this is when euro-dollar reached its lowest levels ever. Not ever, but in many, many years. So this is what we look for. We look for good setups. We look for price coming to similar levels. For example, here, closing price. As you see, this zero is exactly even right now. So we're looking at the closing price, and this is a perfect area to get in. Now, when we go on a smaller time frame, this is 400 and something pips, but I'm sure we will all be happy with a couple of hundred. So I'm going to go on a smaller time frame, like an hour. You're going to notice, we're very back right now. So, okay, here we go. So you're going to notice the price reaching this level many times, but bouncing off. Do you know how many people went buy and buy and buy? Sure, they could have made money, but they could have also lost a lot, because here, when this broke, I bet you many people started selling because they know of this resistance area, support area, sorry. And then price shot up. Okay, this is the FOMC minutes, I believe. No, sorry, this is December 2nd, 3rd. This is December 3rd, and the ECB, and the biggest move in euro dollar in the last, I think, 10 years. But I'll come back to all of these things pretty soon. So what I'm trying to tell you here is, after you master all of the lessons of basically Workshop 23, I can tell you like this: be sure you are right before you open a trade. So even after you even after you understand everything and apply all the rules, you need to be 100% sure before you open a trade. What I'm talking about here is, don't guess. Trade on proven indicators only. And what I mean indicators, to me, indicators are the market, not something that's moving around and telling me do this and do that. Now, these moving averages I've added recently because I want to teach you how to use moving averages on longer time scales, and to show you how cycles work. As you see, this moving average doesn't move much, but every time price has gone above it or under it, it moves rapidly. So if price breaks this moving average, we can see a massive move, or we can use this as a very strong support. I will explain this later on. So what you need to know before you start trading is what I'm going to be talking about for the next few minutes. Okay, you must really know exactly how to apply the 23 rules I spoke about. You need to know how to draw angles and how to use mathematical points of interest. You need to know how to use moving averages to locate bottoms and tops. You need to know how to square, and this is a very hard thing to do, square time with price. You need to know how to use the important 50% levels, which represent a very important area of the market and many areas of interest. So what I'm basically saying is, you must know where to place a stop loss, okay? And I'm always going to talk to you about this. A stop loss is your best friend in this market. And the last thing is, you must look at what cycle the market is in. So these are many checkpoints, and these checkpoints, Lisa can create a trading plan. And if you don't mind, I'd love to help you with the trading plan and show you exactly how it's done. And anybody else that might need help, I'll definitely do this with you, starting from Wednesday. So I'm talking about cycles right now. If all cycles confirm an uptrend, you have yourself a very possible trade with very good potential, provided, of course, that you locate the point at which you want to place your stop loss. Not every trade should be the same. So when you're trading, you can't just use this risk management calculator for every single trade. Okay? You need to spice it up a little bit. When there are setups that you're going to be very sure of, and they're going to make you money and they're going to lose you money. Then there are going to be setups where you're not 100%, and most likely you'll take it because of obviously habit. So on the trades that you're certain, let's say your balance is, let's go a bit lower. Let's say your balance is $1,000. Normally I would tell you to always stick to a risk of 2% per trade. Never risk more than 5% on any given trade. But let's say you find a trade that you're not very certain about. What I'd advise is just go 0.75, and that would allow you to open, nope, even smaller. So 0.05. Now, if you're a scalper, what you're going to see is very small profit, right? On 15 pips, you're going to make $8. But if you're here for the long run, you're not going to look at this only. You're going to understand the percentage gain basis of this. This is 8%. Compounded over consecutive trades, months, and at the end of the year, this tiny little $8 will turn this $1,000 very easily into $2,000 and $3,000, just as long as you have a plan. Where you're going. That's very important. You need to know where you're going. So I just think we have a question. Let me just stop. So Lisa, yes, Lisa, I would love to. So just ping me, send me an email or ping me on Skype, and I will arrange a time with you. Obviously, a good time for you and a good time for me. Excellent. Thank you, Lisa. So now I said if everything confirms an uptrend. Now I'm talking about the other hand of the uptrend, and that is if the cycle shows you that we're in a bear market and that the monthly, weekly, and daily charts show a downtrend. And did you hear what I said? Monthly, weekly, and daily charts show a downtrend. Then it is a good time to go short. That's only logical, right? So again, you must look for very important. You must look for the most important point, where to place a stop loss. That is the most important thing you need to do before you open a trade. Not after you open a trade, but you need to know where your stop loss is going to be before you open a trade. You need to be an artist when it comes to trading. You need to awaken the child inside you with that imagination, because imagination has created pretty much everything, from the computer to the telephone. It all existed in somebody's mind before it was actually created. And I'm pretty sure you all agree with me on this. So you need to find a place where to place a stop loss so that it will not be affecting your trade. And what I mean by this is, if you're going for a long-term trade, I think you need to let your trade breathe a little bit. And what I mean by this is sacrifice a bit of your profits. Open a much smaller position than you normally would. Let's say if you trade with lots normally and you have a $10,000 account, cut down by 50% or 60 or 70 or even 90. Open a 0.1. But you'll have a stop loss that will be strong enough to let you breathe. Trading is and investing, there is a lot of importance that sticks to many parts of it, from risk management to psychology to many other things. And each one of them, without each one of these pillars, everything would fall down. So all of these things that I'm mentioning here are very important. And I'm going to tell you another important factor, and that is when to open a trade. What does the market have to do for you to open a trade? And I'm going to speak about this pretty soon. So if you're trading for bigger pips and pretty much an impressive profit, a risk of 1% of your balance will allow you to open a small trade that, if taken correctly with the right stop loss, can generate you with a lot of safety a 10% return over a few weeks, and if not days. Peter is asking, can trend drawdown be used? What do you mean by this, Peter? I really don't understand. I'm sorry. Okay, the largest pullback in a trend be used for what? You're talking about if the trend is going upwards and then there's a big pullback downwards. Is that what you mean? Okay. To use it exactly for what? To open trades? You've been taught to use them for stop losses. Yes, they are good. I think I showed you this last time when I was opening trades. I said that when opening a trade, let's say we're going long over here. You're talking about putting a stop loss down here or even here. Yes. You can use it. You can use it like that, most definitely. But make sure that the risks add up to your risk management, so you know how much you're risking and be willing to take the hit. Like what Jeff said before, he said that you need to remove psychology from it. Even if you lose a trade, it shouldn't bother you, and that's really important. So when we're opening a trade, I would advise you to use this over here and just drag it down. And let's say if you're opening half a lot and putting your stop loss down here, that's 80 pips, that's $400. You need to know if that is good. because that's a big stop. But yes, you can use it. You can definitely use it. So I'm going to speak about a very important practice right now, and that practice is called paper trading. And most people are very, well, they don't like paper trading. So what I can advise you all, at least if you're trading a demo, why paper trading is good. It's good if used correctly and combined with rules, and not just saying I'll buy here and I'll sell here and I'll buy here and I'll sell here. I don't even recommend spending $5-6 and buying a nice little book, hard-covered book, and calling it, I don't know, call it whatever you like. My trading plan, my whatever, you know. Use some good name, something that motivates you. On the first page, you can have whatever you like. The last page should be your long-term goals, and that book should last you a year. You can document things in there. You can keep track of things, or you can just use an Excel file. I prefer the old-fashioned way. A pen and a paper is always my best friend. So these things help me out the most. Yeah, Jeff says you need to have an I don't care amount. If you care, you will lose. That is very right. So let's go to paper trading. After you feel very sure that you've mastered all of the rules and know exactly how to determine the trend of an asset and the time and place to take a trade, then, my friends, to make yourself double sure about all of this and establish confidence in yourself, you just need to practice paper trading until you fully understand how to use the rules and when to use them. So it's not only having them written down next to you, it's using them, knowing when to use them, and most of all, how to use them. I mean, if you make mistakes trading on paper, then this means that you would make mistakes in actual trading. And this means that you're not ready to begin trading. So when you feel that you're competent to start trading, and I'm going to underline this, apply all of the rules and trade only on definite indications of the market. What is a definite indication? Well, there isn't a very definite indication, but what we can use is history. And history tells us that double tops work, double bottoms work, channels work, head and shoulders work. These things work, and these are the things we should look and try to determine when will happen and when we take those risks, because these movements normally have decent moves. For example, this over here. And I'm just catching this one here. I just want to show you. I'm catching this level and not this level. Okay, so if you were to take a trade here, and most of you did today because this is what I sent you. This is a good indication. And by compounding this or using the pyramid strategy onto this, you can make very impressive returns, because on a pyramid strategy, on a currency pair, if you get $100, you're making you're making a minimum of 5%. Depending, of course, on what I'm talking about with minimal risk. So if you're not sure of the trend or the buying and selling price and not sure where to place a stop loss, then my best advice is wait until you got a definite indication. You can always make money by waiting for opportunities. Okay, you can always make money by waiting for opportunities. There is no use of getting into trades of guesses. They will only make you lose over the long run. Even if some of them win, long term, you're going to be losing, and you're here to be a professional. You're not here to be just another guy or girl from the 95%. You're here to make money. You're here to have an impact on your finances, on your knowledge, and your life. Trading can be really interesting and really fun. But wait until you start losing a lot in it. And then when you wake up, the last thing you want to do is look at your computer. And you'll find all the reasons and excuses why you can't be a trader. And many people have. That is why many people stop. And then there's those few that decide to say, you know what? If I want to make money in this industry, I need to learn a couple of things. I need to, you've all lost, I'm pretty sure, because I've lost. I lost a lot, but I also made a lot after that because I knew something was wrong. And I didn't change the way I trade. I just improved the way I trade. I cleaned my chart. I started looking at things. I started speaking to my chart. I wanted to understand why things happen, how they happen, and I would try to predict them. We'll talk about this another time, though. Let's talk about when to close a trade. After you start actual trading, when you take a trade, don't close it or take profits until you have a definite indication, according to the rules, that it is time to sell out or buy in, or move your stop loss closer and wait until it's caught. The way to make success is to follow the trend always and not to get out or close a trade pretty much until you don't have a certain indication that there is a reversal in trend or price is about to jump up rapidly before going down. You can't predict this all the time. You probably won't ever predict it. Who can say where the market is going to be in 5 seconds, let alone 10, 20, 30 minutes? It's impossible. We can increase our chances by understanding a bit more of the technicals of the market and how it moves. It always creates channels and then has rapid moves up or down. Channels and then rapid moves in directions. Channels normally don't last more than 3. 1, 2, 3, 1, 2, broken. 1, 2, 3. This is a double top, double bottom, double top. Perfect time to make money. But most people don't see this because they don't look at long-term time frames. Jeff, you have a lot of knowledge. You're very correct. He says that 80% of breakouts fail. Yes, most of them fail because they're designed for us to pop in so that the markets can take a lot of money out of us. And by the markets, I mean the banks. So let's go into the capital required for trading. Before you do any kind of trading, you basically must know the amount of capital required to achieve success in the financial markets and the exact amount that you must risk on any given trade in order to always have capital left over to trade with. You remember what I said before? I said that if you don't open a trade, you can't win, but if you lose all your money, you can't trade. So you can obviously begin opening positions of 0.01 or 0.1 or even one lot or even higher. I don't know what you guys really trade. But the main point that I have to tell you here is rule number 1. Divide your capital properly and distribute the risks equally to protect your asset. And your asset is your capital. It is your most important asset. Well, right after your knowledge. So whatever amount of capital you use to trade with, I just want you to follow this rule. Divide your capital into 10 equal parts and never, ever risk more than a given percentage. And I would really recommend that percentage to be 2% and not more. I'm talking about even under. So should you lose 5 consecutive times, let's say if you open 2% risk, okay, and you lose 5 consecutive times, then all you have to do is reduce your trade size and only risk. Again, what I'm talking about is reducing your trade size, not your risk that much, but reducing your trade size in order to have a bigger stop, or even lowering your risks. So if you follow this rule, believe me, your success is going to be very sure. And I'm going to explain this as a general rule. I've always considered this very advisable. Let's say you have at least $1,000. This is what I believe. 4-digit numbers work much better than 3-digit numbers. So at $1,000 capital, if you're trading mini lots, to limit your risks to about 2% for the start, which will basically allow you to open. Well, what I'm trying to tell you here is this. Let's say your capital is $1,000. You limit your risk to 2% per trade. That means you're opening 0.1 positions. Okay, so that's 0.1 of a lot. 10% of one lot. Your stop loss would be 20 pips on euro dollar. In this way, you will be able to make 10 trades on your capital, and the market would have to beat you 50 consecutive times in order to wipe up your capital. So that means taking a risk of 2% and taking 50 consecutive losses, which don't happen, you would only then lose your capital. And believe me, the market will not do this, and you will not do that. So you should try to make trades at a price where it will only be necessary to use a smaller stop loss, which would basically cut down your losses. So what I'm saying is your stop loss doesn't have to be always 20 pips or whatever the risk management tells you. It shouldn't be 15. It shouldn't be less than 10. But then what I'm saying is it can be 18, 17. This way you're cutting down your losses a little bit and increasing your capital. You're protecting your capital. This is why we're here. To make our capital make you money, we need to protect our capital at all times because this is your initial investment. If you lose profits, that's fine. Never lose your initial investment. So try to make it in about 10, 20 trades. You need to try and make that about 10%. If you can make 10%, then just risk that 10%. So if you're trading with 1,000 and you make 100, then slow down. Start trading with only 200 of your money. Basically, you limit your risk to only 10%. Limiting risk is essential. So if you want to start trading in smaller sizes, and by this I mean is if you do not have enough funds to make a higher initial investment, then simply lower your risks and trade sizes. Play around with the risk management that I sent, and basically if you need any help or guidance for this, just get in touch with us, and I'm sure one of us will help you out to help you set this crucial part of trading. I'm going to go now to something what obviously I think is very important, and that's to always follow your rules. You need to decide this important point before you start trading. And if you do not intend to follow rules strictly, I'm telling you, friendly here, do not get into trading. Never will guesswork or human element make you money in this market. And you should never let guesswork or human element to accompany you into this market. You need to stick to the capital rule, if you remember that one. And under no condition risk more than the allowed percentage on any given trade. If you follow this mathematical rule, I promise you, you will become successful. Yes, you can. I'm going to just put it into the chat right here, and you're going to have it. Just a moment. So you will be able to download it right from here. I think you already can. Nelson, can you please confirm to me that you can see the risk management calculator? Okay, no, there was an error, so just a second. Okay, I think you can see it right now, so you can get it from there. Perfect. Just pick it up. So I'm almost at what you're all here for, and that's the law of compounding. I know deep down inside of you, you all like this strategy a lot. So I told you, follow the capital rule. If you follow mathematical rules, you will be able to achieve success in the markets because, well, you'll know what you need to achieve, and you'll basically use the law of averages to your advantage. So here I am, the law of compounding, or in other words, pyramiding. You should only pyramid and increase your trading activity in the markets when volume is above normal. What I'm talking about is volatile sessions, where prices of euro-dollar move by 60, 70, or 100 or 80 pips, on average at 80 pips a day, euro-USD. So this is the assets you should trade. Gold is very good for this as well, but you need to get it right because gold can eat you up very quickly. So price will basically give you a good reason to enter a trade. If you use the law of vibration for this, the mathematical points of interest I spoke about, or better the 50% levels, this, so this over here, if you use these levels, you'll be able to enter the markets with higher success and grab decent tips. I definitely advise you to look at this on a 4-hour chart because movement between each other, as you see here, is normally the average movement on a pair, and that's 80 pips. See, this is the average movement this pair, the pair here does. Oh, I need to put one more level here, but it's about 80 pips. This is the average movement of euro-dollar, and if we go on gold, we'll get the average movement, the average daily movement Obviously, some days are very strong and they move 200-300 pips, but the average daily movement is seen in the 50%, and that's another reason it works well. So you should never begin pyramiding until an asset has gotten off into a strong position on the 50% levels or into a very weak position, which I'm talking about is a double bottom, for example. That is a weak position. Yes, price is in the money, but it's a weak position, meaning price will head upwards most likely. Or the best time to use pyramiding is when the pair has broken out of a trading range or is crossing all tops or even breaking all bottoms. So how to use the pyramid or the compounding strategy is very simple. I'm going to give you an example. Let's say you have an account of $10,000, and we use this in our asset management very, very well, and it's been generating very impressive results for a very long time. We haven't been active last week because I was pretty much away, so I wasn't active last week. But this week we already started, and we have, in the aggressive side, we have just over 12%. And the rest, the calculations are still not done. So you have a $10,000 account, and you're trading one lot positions, okay? After you've made your first trade with a limited risk of 2%, which is 20 pips, $200, then you do not pyramid or basically buy or sell a second position until the market has moved at the minimum, and this is very small, 10 pips in your favor. If you're very conservative, this is what I'm saying. Then when the second position comes out, you need to round up the stop loss, and I'm going to show this again, towards the first position by putting it in profit, second position by putting it into profit. If this doesn't make sense, I'm going to show it to you live. And basically you need to make sure that if the stop losses are hit, you will make a small profit on two trades. When the market moves another 10 pips in your favor, then you open a third position, and so on and so on. This compounded action can generate very, very impressive profits if you get the correct side of the daily or weekly or monthly market movement. Obviously, you need to use stop losses, and you need to always adjust them. Do not put trading, do not put pending orders. Don't put pending orders in the market and then leave from your station, because even that 10-minute bathroom break or cigarette break or glass of water can cost you a lot of money. So the best money in pyramiding is made on setups like double tops, double bottoms, and technical setups like this, but mainly the biggest money is in trends. That's why I sit here all day and try and find trends, because that is exactly where the most money can be made. Now, it is very important to have a clear written rules for pyramiding. For example, gold moves different than euro dollar, and most currencies actually move much different from the other one. And they all move in different daily, weekly, and monthly, and yearly ranges. So if I can give you a task, I tell you to find them and use them. Use different stop losses for these different pairs. The safest pyramiding rule is very simple. It is for you to use pyramiding when assets are selling at extremely high or low levels. Basically, to start off, so let me explain it to you like this, live. This is a very low level, right? So it came to a very low level. Chances are prices normally bounce back. And just like here, prices bounce back. I would advise people to start a very small position. Even if your account is 10,000, I would advise you to start off. Let's say the first lot would be 0.6. You know, the second one 0.5, the third one 0.3. And when you come to the third one, you can actually stick to that value. You don't have to go lower. So if the first position is one lot, the second is 0.8, the third one can be 0.6, and then at 0.6 you can just continue putting on the same trade constantly. I just pressed the button here. Can you guys still see the screen? Okay, good. You can see the trading platform, correct? Okay, very good. Very, very good. I'm not going to be opening any trades today because the market movement is pretty much done for the US session. So what we're going to be doing is on Wednesday's session, we're going to be opening trades live. So I'm sorry I didn't say this earlier, I just totally forgot. So one of the safest rules to use for pyramiding is when an asset are basically selling at extremely high or low levels, it is to start off with smaller positions, and when the market moves in your favor, you continue to buy or sell more positions but with lower lot sizes. So the example I'm trying to give you is, let's say the first position is one lot, the second is 0.8, the third is 0.6, and when you come to 0.6, you can stick to 0.6 because regardless of what happens, you're making a profit. So when not to pyramid is something I want to state here today as well. Safety is the first consideration in starting or continuing a pyramid in the financial markets. Mistakes are made by buying or selling the second position too near the accumulation or the distribution point. So after a big move, up or down, you must always wait for a definite change of trend before you start your pyramid. Don't just keep trying to do it all the time, because if you keep doing it all the time, you're going to continue making very small profits. You don't want to do this. Open your daily trades here and there, but when markets come to specific setups, that's when you start pyramiding, because you want to accumulate at least 100 pips. Because if you grab at least 100 pips, you're making a very impressive profit. Because even that first position would still give you a good profit. Imagine 4 of them. So basically what I'm saying is always check and double check. Follow the rules. Study the major and minor cycles for forecasting. The angles from tops to bottoms. What I mean is this. You can even use the Fibonacci fan on this, and it could definitely help you in understanding where markets stop and where they go. For example, here, and then you come to the next one. You can fix them. I can show about this the next time a bit more on this. So basically, angles from tops and bottoms, the 50% levels of tops and bottoms, because if you ignore one important point, it may get you wrong. Okay, so it's very important to understand the market as a whole and don't rush, even if you don't have too much time. When you understand your chart and you have a simple chart, you can very easily, in a couple of minutes, understand what's happening. Look for a trade by scrolling through your symbols, and you'll be able to find a very good setup for yourself and take a very good trade where you would make money. So you can see that price is at this level here. I'm not going to be opening any trades because since we started speaking, this position here was losing, I think, 11 pips, and it's been ranging between 8 and 11 pips, and it's just staying there. So the markets are pretty dead. It's Monday. We did have good movements. Euro USD moved at its average pace of approximately 80 pips. Gold retraced massively from those big moves last week. And yeah. So I just want everyone to remember that success can never be exceeded. It can never exceed all of its parts. So basically, these rules can only work and make up success if they're together. So if you break one of them, it's like breaking pillars. You break one, the second one will go, the third one will go, the fourth one will go. So make sure that your trading rules are there. If they're not these 23, use something else. It's very important to have something, because if you leave out one of the parts or don't even follow the rules, you basically don't have a complete trading system. Yes, Attila. Yes, I will. I will call you. I'm just going to put on basically make a change of clothes, and on my way out, I'm going to a meeting, which starts in 18 minutes. I'm going to call you. So yeah, everyone, what I'm basically telling you here is pretty simple. This session is scripted, so I scripted it for you. I read through it. And what I'm going to do is save this into a PDF. Just fix up my spelling mistakes, because I did this. I was doing this on my way home, so I didn't have too much time to finish it. But this is just another part of the bigger picture. And on Wednesday, we're going to do a lot of live trading, and I'm going to go into a few more ideas of trading. But before I finish, does anybody have any questions for me? Yes, sir, we do. Yes, we do place trades for our clients in the Private Investment Club. It's basically a hedge fund. We are basically doing asset management, and that's what we specialize in. And what we're teaching you here is the way we manage people's funds and our funds. So you're learning directly from us. I've sent the wrong thing, huh? Well, I'm sorry. I'm sorry, Nelson. Of course I can. I just dragged and dropped the wrong thing there. So I think it's not sending because I'm using it. So I'm just gonna switch it off. Hey Peter, I think I'm really happy that you think this way. Okay, Nelson is there, so you can get it. Peter, I'd like to have a call with you tomorrow so I can show you a couple of things in the morning. If there's, well, my morning, your midday. So I'd love to get on a call with you and just go over a couple of things because there has been some good trading in the fund, so some good profits will be distributed. Perfect. Lisa, you're very welcome, and this is pretty much only the beginning. There is still a lot of things I need to tell you all, but the way I train is very scattered. I'd like to throw many things at people. I want to see what people are interested in. I want to give you the whole picture, but in parts. So I'm going to come back to the rules again, and I'm going to even create a video that will be a bit longer throughout the day because I know everyone's busy. So I'm going to record myself most likely this week opening trades in our private investment club. This will be a video off my screen mixed with somebody recording me while I'm explaining, basically while I'm speaking, so you can all understand what we do here. And I'm pretty sure it will help you a little bit more. It will be like a documentary, and I'll begin this week. Jeff, thank you for coming. I'm very happy to have you here as well. There has been some activity on your account already. I think you're 2% up on the medium, and the aggressive will be added in pretty soon. And because I'm going to be leaving, you should never leave your your PC or your trading station without the take profit. So if I'm leaving, take profit added. Since my computer will be on, I will put my trailing stop 12.6, and that's it. Me too, Nelson. I really look forward to it as well. And if anybody would like a private session tomorrow, just ping me on Skype, and I'll be more than happy to to do the session with you. Lisa, you know what? You are a very bright lady, and I'm sure that I'm going to learn a lot from you too. Okay, everyone, thank you very much. I'm going to stop the recording now, and I'm going to end the session.